Hey, this is a nice little chart from the St. Louis Fed here. They've got a lot of great stuff here. The what's known as the Fred, basically. Um, but I just changed this. So basically, this is the 10-year minus the 2 year. So the 10-2, the 2-10 Treasury spread, the yield spread between those two maturities. And so basically, when it goes negative, it means that the 2 year, because it's being subtracted from the 10-year, is higher, is yielding more than the 10 year. The shorter term duration bill is yielding more than the longer term duration bill, which is very uncommon. And so what you can see here is that when it does go negative, when the shorter term 2 year is yielding more than the longer term 10 year, then a recession happens. And that's what this kind of darker boxes here. And obviously, if you all remember from, so this is the dot-com crash, basically right here. And, right here, this gap is September 11th. That was the gap on when September 11th, 2001 happened, right there. And then we all know the 2007 great financial crisis, economic collapse, et cetera, et cetera. But what's really interesting is the timing on all of this. And it's not exact or anything like that. I write that it's 12 to 18 months after. Obviously, this is right around, so this is like a December here. I just can't get it to be spot on here. But, late December, and then this is early March. So that's 2.5 months there. And then when it comes out, well, okay, like which one do you pick here? So I kind of got it inverted here, and then it kind of spiked back up, and now it's just kind of, almost 0, 0, 0. They're yielding the same, then it goes a little bit negative, and then it comes back out, and then it bounces back down again. It's not exact. It's a forewarning. All right. So sometimes people say that, hey, when you enter the yield curve, then it's like 12 to 18 months after. What I've usually determined is that, like, hey, after the yield curve reverts, goes back to normal, is when then you can start counting. It's not exact. It's basically like, hey, this is not normal. Be on the lookout for when it turns normal. Oh, it came back to not being normal. Be on the lookout to when it returns normal, and then be on the lookout for something maybe more major happening, probably from a downside economic situation. So what really amazes me is that as we go into these economic challenging times, the yields increase. Investors want more of a return than they did previously because of the more challenging times. And you can even take this back to longer duration time frames here. I guess it goes back to 76, and even, have it come out to almost today. And you can just see here, you're coming out of the 70s stagflationary times. It's bouncing back and forth. Like, you just expect for some uncertainty ahead. Okay. Obviously, then in the early 90s, you're kind of coming out of the ag crisis here, and a real estate downturn, the land price downturn here, and then you're bouncing around. So even if you zoom into this period, I guess I can't zoom into that period. So if I were to zoom into this period here, you can see that it's bouncing around a lot. Okay. I kind of showed you this period here, and then we have the COVID-induced little recession here. Now, I don't know exactly what this recession time frame means. If this is like the GDP data, which is GDP data is how much we spend, how much we produce. I guess produce. GDP is how much we produce. So what does producing have to deal with investors gaining, desiring more yield, more return for their investment? I don't know if they have a lot to do with each other, but that's what the determination is. I can't make this stuff up, guys. It just is what it is. But anyways, I just figured it was a little video as I was dovetailing into this morning. Hopefully that helps a little bit. But basically, hey, the headlines are flashing inverted yield curve. Okay, something to be aware of, not to panic. All right. Headlines are flashing, the yield curve reverts. The yield curve is normal. Okay, that's good. More normal economy. Maybe something a little bit bad's on the horizon. maybe I should dig into it, be prepared, et cetera, et cetera. And that could come in, 6, 12, 18 months down the road. I think this next downturn, because this inversion right here, which I've got a chart of, which I just got a still picture of in this post, because this chart right here is so inverted for such a long time frame, the next recession is going to be out into this time frame out here. It's not going to be right here. And actually, let me just what is today, the 24th, I think, 24th. Did that update? There we go. So yeah, I mean, it's going to be out here into the end of 2026, everything like that. Yeah, that's my hypothesis. Hope you find this helpful.